All right, I'm not that worried. Okay, but let me repeat. Thank you. Okay. Welcome to the second lecture that Aravind is actually running. Aravind used to be an old boy at Melbourne High performing student, very well responding. So he's going to have some very amazing insights into how to get high marks in accounting. It's also very fortunate that this is free, so hopefully appreciate that he's actually taken his own time to come to this for you. So there's a lot to learn. I think we're going to questions are invited, correct?
Yes.
So any questions, you'll voice up in class. But I think we're very fortunate. Let's see around the applause there. Aravind.
Thank you, Mr. Murata. Nice to have you all here, some familiar faces in the crowd. I'll just play a short video of a brief recap of our lecture from last time, just to start us off. That's going to work. I started this business with my best mate because we wanted a genuine business that was by students, for students. So we were able to relate to what students actually wanted in tutoring and seminars, and we created a course that was relatable, enjoyable, social, interactive. So I think we've been able to deliver high quality premium educational service, and the children also have fun and make friends along the way. All right. So, yeah, AT Academy is a company that I started with my best mate when we were year 12s at Melbourne High. As mentioned, I have majority been doing VCE accounting over the past 8 years, and slowly we will add on business management as well. So a bit about me, I was MHS class of 16, the accounting ducks of 2015. I then did a Bachelor of Commerce, accounting major at Monash Uni, and I'm currently finishing up my chartered accountancy. I've got my last exam in September. I also do some first year stats lecturing at Monash University. Vimani, do you like to introduce yourself?
Hi, I'm Vimani, and I am from Wembley, and I graduated last year. I'm currently doing Bachelor of Physio at Monash Uni, and just had an exam today too, which is fun. Yeah, and I just work with Aravind a bit, just making some, collating some notes together and things like that. Yeah, just help him out wherever. Yeah, that's me.
Thank you, Vimani. Vimani does a lot of work behind the scenes. I am the face, let's say, but sometimes, those who do the admin and all those don't go unrecognized, but definitely do appreciate yours and everyone else's contribution. So some basic tips to succeed. With outcome to SAC, I know Melbourne High has their SAC, I think it's the day before the GAT on the 17th. So there's a lot of outcome to SACs floating around. In the back of your booklet there, pages 16 onwards, there is a SAC that I am just releasing now. It's a brand new SAC for you all. I will send out solutions in the next couple of days with for that SAC. So hopefully after today's session, you will be in a good position to do it, whether you want to do it straight after this session or a bit closer to the 17th. I'm sure you would also have a lot of materials available on Compass and so on. My recommendation is when you're at the point of, doing your trial exams, get into a study group, get your friends together and do some cross marking. It's sometimes, more fun if you're working with your friends. If you're just marking yourself again and again, you may not learn as much as you can, but having another perspective can also help. So the first topic today, and I've made the booklet in a way which should mirror the slides. So the first topic today is closing entries. So I think it would have been in chapter 3 for those of you who use the Cambridge textbook. Early on, you would have learned how to balance the balance sheet accounts. So asset, liability, and owner's equity accounts. So these accounts are balanced and carried forward to the next reporting period as per the going concern assumption. Because we know we have, our accounts receivable, we assume that the business will be around to collect the money from those accounts receivable. We assume that we will be around to repay our credit suppliers and so on. But with closing entries, with the income statement accounts, revenues, expenses, even negative revenues, we need to close them, meaning we have to reset them to 0 such that, we can calculate an accurate profit. And this is done as per the period assumption. So as I've said, first reason is to determine an accurate net profit or loss by comparing revenues earned and expenses incurred for the reporting period. And secondly, it is to reset account balances to 0 in preparation for the next reporting period. And there is a simple 4-step process that you can get to know so that you will be able to do this. And sometimes VCA and your schools will assess it as all 4 as journals, all as ledgers, or a bit of both. I've seen it done in all 3 ways. So the first step of closing entries, step 1, we close the revenues and sales returns to the profit and loss summary. So usually we have revenues as having a credit balance, and sales returns as a negative revenue has a debit balance. So whatever the value of your revenue is in your credit side, you have to debit it by that full amount. Similarly, with your sales returns, it has a debit balance. You have to credit it by the full amount. And then you will credit the profit and loss summary by the difference. So the profit and loss summary is an account you open and close on the same day, which is just used functionally to determine an accurate net profit or loss for the reporting period. Once we complete all of these steps, the profit and loss summary also balances to 0, and there will be no carry forward balance. So that is step 1. Step 2, expenses will usually have a debit balance. So we credit the expenses to make it 0 and debit the profit and loss summary. This one is a little simpler because we don't have the added complication of sales returns. But one thing you should keep note of, and I have seen it done in several company and my own trial exams, is that they may not always give you the cost of sales figure, but they will just give you somewhere in the question what the markup percentage is. You're expected to be able to calculate what the cost of sales is, because every business within the VCE course is some business which sells an item. There are no service businesses in the 3-4 course. So where there is a sale, there naturally has to be a cost of sale. So that's the first 2 steps. Step 3, you transfer net profit or net loss from profit and loss summary to capital. So you weigh up your revenues and your expenses. If your revenues earned are greater than your expenses incurred, that's a net profit. So you debit profit and loss summary and credit capital. Since the capital is an owner's equity account, you would know from the basic debit credit theory that an increase in your capital account is credit. So if you have a profit, it should make sense intuitively that you will be crediting your capital. For a net loss, however, revenues earned are less than expenses incurred. So you would debit capital and credit the profit and loss summary. As owner's equity capital accounts increase on the credit side, it would decrease on the debit side. So having a net loss would decrease capital. Finally, step 4 of this process, you are transferring drawings to capital. So with drawings, it's a negative owner's equity account with an increase on the debit side and a decrease on the credit side. So whatever your drawings value is, you credit it so that the drawings will be closed off, and then you debit your capital account. Your capital is an owner's equity account, and to decrease it, you debit it. So debit capital, credit drawings. That is the 4 steps. Manager, you have to send it to the overall group chat, not to me. All right, we will do an example question now. So this question I've given in the booklet with the solutions, but the next couple of questions, you guys will have a bit of a go on your own. So in this question here, I've given you a bit of background as to what the business is doing. And I mentioned the markup. And I've given you a list of dot points about the revenues and expenses. So net sales is not necessarily an amount that you can put straight into the P&L summary. Can anyone from the audience tell me what net sales is and how we would calculate it? Aryan. Sales minus sales returns. So if I've given you net sales here and I've given you sales returns, how would we calculate sales? What would the value be, Aryan? No. 100,000. Other way. Net sales is sales minus sales returns. So sales equals net sales plus sales returns. So 90,000 plus 100,000. Because the markup is 100%, we would calculate cost of sales based on the net sales. So cost of sales would be 45,000. Inventory gain and revenue, discount revenue would be the other revenues. And advertising expense, wages expense, and interest expense would be the expenses. Drawings being a total of 12,000. So the first step here, I have given you the solutions in the booklet for the first question. The next question, I'm going to get you guys to do on your own. So the first question here is, the first step is to close revenues and sales returns to P&L summary. So as we mentioned, sales is 100,000, discount revenue is 2,000, inventory gain is 5,000, sales returns is 10,000. So when you look at sales and sales returns and you take 100,000 minus 10,000, you can get your net sales of 90,000. You subtract everything and you would get a profit and loss summary of 97,000. That's step 1.
Okay, with step 2, you're closing off your expenses. So you've got your, well, we'll start crediting all of our expenses first. So we've got the markup, which was 100%. So to find cost of sales, you just do the sales divided by 2 because it's 100% markup. Yeah. And then, well, you do net sales divided by 2 because of the sales returns. So you get 45,000 and you credit that. And then you've got your advertising expense as well as wages and interest. So just do all the expenses, go through the list and make sure you're meticulous with this. It's easy to miss things. And then just add them all up and then you debit the total, which would be 58,000. So yeah, that one's pretty straightforward. This is the only thing there is to keep in mind the markup, because a lot of questions will just give you the markup and won't tell you what the cost of sales are. And yeah.
All right, so we've had 97,000 of revenues and 58,000 of expenses. So that would be a net profit, 97,000 minus 39,000. Sorry, 97,000 minus 58,000 to get 39,000 profit. And since it's a profit, capital will be credited. So debit profit and loss summary, 39,000, and credit capital, 39,000. That's your third step. Finally, you transfer drawings to capital. Debit capital, 12,000, and credit drawings, 12,000. All right, now over to you guys. We will do a very similar style of question. There is an added complication in this next question, but I want you guys to have a go. And if anyone's feeling brave enough, you can come and give a response. Are we finished or we need a couple more minutes? All right, guys. We'll go through this question now. Savati. First two steps, then last two steps.
Wait.
Yeah, that's the workings. That's the steps.
Let us start talking.
Yeah. Silence, guys.
Okay, so
Yeah.
okay. So for the 30th June,
Guys. Yeah.
So on the 30th June, sales debit 92,000, inventory gain debit 3,450, sales return credit 8,000, and then profit and loss summary credit 8,700. No, yeah, 87,400. And then profit or loss summary debit 73,000, cost of sales credit 56,000, wages expense credit 12,000, insurance expense credit 5,000, and then profit and loss summary debit 14,450, and capital credit 14,450, and then you debit capital 17,000 and drawing 17,000. That's it. Thank you.
All right. So just to go back a step, everything was all right. Thank you, Savati. A round of applause for Savati, guys. there aren't many people who would have the courage to come up and give an answer, especially to such a tough question. And it was a correct answer as well. There is a little bit of controversy in this question, especially with regards to the calculation of the sales returns and the cost of sales. So I just want to expand a little bit upon that. So there is a couple of things that they have given you in the question. You have this in front of you, so I'm going to keep on this slide. So it tells you that net credit sales is 72,000, and it tells you that sales returns is 10% of credit sales. So because we know that net credit sales equals credit sales minus sales returns, you can substitute the fact that sales returns equals 10% of credit sales. So if you look at the second line here, 72,000 equals 100% of credit sales minus 10% of credit sales. Guys, listen up. So 72,000 equals 90% of credit sales. So therefore, 100% of credit sales equals 80,000. And therefore, 10% of credit sales, which is the sales returns, is 8,000. So that's how we get a figure of 8,000 for sales returns. Does that make sense to everyone? Okay, cool. So then, cost of sales is calculated on the net sales. Net sales, not net credit sales, but net sales, since we have both cash and credit. So net sales equals 92,000 minus 8,000, which is 84,000. So 84,000 divided by 100% plus 50%, so 150%. So then you get 84,000 divided by 1.5, which is 56,000. You look at the revenues, you look at the expenses, you get the profit of 14,450, and that's pretty much it. Are there any queries regarding this? Does it all make sense? Okay. We'll do another question similar to this, but this time it's the ledgers. It's not the journals, it's the ledgers. Some of you may have seen this question recently, but I don't think you got it right. So let's have another go anyway. Bimani and I will come around and help you guys. So just put your hand up. The room mic too soft. Yeah, that's nice. I think that's give it a try. Not, I'm changing it. I'll try.
അടിച്ചിടണം.
All right, guys. Tiara, come on down.
Okay, so for the profit and loss summary, on the debit side, we have the date 30th of April, and it's under the cross-reference of expenses, and you get 68,400. Cost of sales being 56,400, plus wages incurred being 12,000. And then credit side, 30th of April is the date. Cross-reference is revenues, amount is 115,300. Students, total sales is 120,000. And then sales returns is 7,200. And then you add interest earned, so it's 2,500, that's how you get the revenues. And then the difference between that is 46,900, which is the overall net profit for the business. So it'll be 30th of April, date, cross-reference is capital, and then 46,900. And you don't balance that because it's a profit and loss summary ledger. And then the next ledger is a capital one. You've got drawings, debited 30,000 as it's being given to you on the drawings ledger, and you have your balance, and then you transfer profit, credit to capital 46,900, and then you balance it. So the balance will be 266,900 for May 1st. And then the drawings you've been given the debited, but you need to transfer it to capital. So 30th of April, cross-reference is capital, 30,000 credit, and then it's cross-referenced. That's it.
All right, thank you. Okay, does anyone have any follow-up questions to that? Yeah. Yes, we should always write the subtotals at the bottom of each of our letters. Okay, cool. All right, the next thing I will go to is the income statement. So this is a standard income statement template that you should expect to see. This could be assessed. You could be asked to prepare an income statement. In the trial sack that I have put at the end of the booklet, you're asked to prepare a income statement template for up to and including adjusted gross profit. So that is something that you could always have. I did have a briefing by the chief examiner a couple of weeks ago, and they mentioned instead of putting a 10-mark cash flow statement, they might put a 4-mark income statement extract, a 3-mark cash flow statement extract, and a 3-mark balance sheet extract. This way, they can assess your understanding of all 3 reports rather than just one report for 10 marks. And they're still using the 10 marks, but they're assessing the understanding of all 3. So going down the template, vertically, we get sales, 100,000, subtract sales returns of 5,000 to get net sales of 95,000, and less cost of goods sold. Cost of sales is 47,500. Freight in is 1,000. So your total cost of goods sold is 48,500. Gross profit would be 46,500. Less inventory loss or add inventory gain, less inventory write down. So then 200 plus 300 equals 500. So then your adjusted gross profit will be 46,000. Add other revenue would be discount revenue, interest revenue, 500, 400 to equal 900. So then your adjusted gross profit plus your other revenues would equal to 46,900. Then you do your less other expenses. So advertising, 2,000, discount expense, 3,000, interest expense, 1,500, and wages expense, 7,500 to equal 14,000. So then your 46,900 less other expenses equal 32,900 as your net profit. So that's the template. I have put it in the booklet. So the next slide is the performance indicators. I'll go through this slide briefly and explain NPM and GPM, and then we'll have a short 5-minute break with some snacks and drinks. So based off the income statement, we can calculate a couple of ratios. So the first ratio is net profit margin. Net profit margin is how much profit we're retaining from our net sales. So by definition, it's a profitability indicator that indicates expense control by calculating the percentage of net sales revenue that is retained as net profit. So by the way, I have told my students this 100,000 times go to the VCAR study design, page 10. While you're there, grab page 11 as well. It has all the FIFO and identified cost rules for stock recording. But page 10 has all your 12 performance indicators for the year. It'll have the ratios, formulas, what it's expressed as well as the change or trend. Because some ratios, there'll be increase or decrease, faster, slower, and so on. And, it could be expressed as percentage, times per period, number of days, if we're looking at ATO, ITO, APTO, and so on. Okay, so an example calculation is net profit margin equals net profit over net sales, being 32,900 net profit over 95,000 net sales. So you get 34.6%, rounded to 35%. You won't ever be asked to calculate the ratios or the formulas, but if you were asked, that's how you would do it. And it's not necessarily about needing to know how to calculate the ratio. It's about your ability to interpret them, because questions will ask about trends from going from NPM from 30% to 35% to 40%. So how does a ratio increase? A ratio will increase either by the increase in the numerator or the decrease in the denominator. So we need to know the formulas so that we're able to do that. GPM, gross profit margin, is a profitability indicator that measures the average markup by calculating the percentage of net sales revenue that is retained as gross profit. So in the previous example, we had a gross profit of 46,500 and a net sales of 95,000. So if gross profit margin equals gross profit over net sales, you get 46,500 over 95,000, which equals 48.9%, rounded to 49%. So that is expressed, both of them are expressed as percentages, and the changes are increase or decrease. So we'll give you guys a 5-minute break. We've got plenty of drinks and snacks here up front. So come down, have some drinks and snacks, and we'll move on to the next one. Question? It's 4:54 now. We will start again at 5 o'clock. No, we're getting it. So when
better than your vacuum cleaner. Your vacuum cleaner. No, you can. Okay, I think I'll talk to you later.
Like, I'll get in touch with some of the elements. We can make some advice on this. Like, I can send you the each one and also past payments. Send me an email. I'm not with that. Oh, Two minutes to start. Amrish. This is Suraj. All right, guys, take a seat. We'll get started. We'll probably go for the next half an hour, and then I'll stay back a bit for Q&As. So, the cash flow statement. Silence. The cash flow statement is split up into 3 different activities. So, operating activities, investing activities, and financing activities. The easiest way to allocate this when you're doing your question and looking through a list of inflows and outflows is to get 3 highlighters, highlight the investing ones, highlight the operating ones, and then the rest will all naturally be highlight investing, highlight financing, and the rest will all be operating. So use red, yellow, green, like a traffic light system. Okay, so let's go through this template. Cash sales, let's say it's 100,000. GST received is 15,000 because it's 10,000 from the cash sales and it's 50,000 from the sale of equipment. Per the VCA FAQ, GST does apply to the sale of a non-current asset. You guys wouldn't have covered that part yet because it's in Unit 4. But when you're doing your investing activities, all of the GST in the purchases and sales will need to be considered in your operating. So cash sales, 100,000, GST received, 15,000, receipts from accounts receivable, 20,000. Add them up, you get 135,000. Going to your outflows, payments to accounts payable is 15,000. Cash purchases of inventory, 75,000. Wages, 12. Advertising, 4,000. And interest, 2,000. I have put an asterisk on all those things which attract GST. So cash purchases of inventory, advertising paid, and purchase of equipment. So you get 75,000 plus 4,000 plus 20,000, which is 99,000, 10% of which is your GST paid. So all of your operating outflows added together equals to 117,900. So then net cash flows from operations, 17,100. Cash flows from investing activities, sale of equipment, 50,000. Purchase of computer, 20,000. So then overall 30,000. So operating activities is your day-to-day trading activities. Investing is anything to do with purchase and sale of non-current assets. And then financing is any changes to financial structure. So going down to the financing activities outflows, loan is 10,000, capital 20,000 to get a total of 30,000. And then loan repayment is 5,000, drawings is 15,000, getting to 20,000 outflows. So then 30,000 minus 20,000 is 10,000 net cash flows from financing activities. So you then take the net cash flows from operations, the cash flows from investing activities, and then the net cash flows from financing. So the 3 nets, add them together, and you get 57,100. Add your opening balance of 20,000 to get the ending balance of 77,100. Okay, so that's a template. You can keep this template. I'll send you the PowerPoint so you have the original. You can copy it into a Word document and add and subtract things when you get more entries to put in Unit 4. You can make your own template based off this, based on my income statement, and annotate it. You can annotate the one in the booklet as well. And yeah, some tips here. So when you're talking about loan repayments, there are principal repayments, which are financing outflows, but there are interest repayments, which are operating outflows. So one transaction, let's say, can affect 2 different areas of the cash flow statement. GST, in terms of operating inflows and outflows needs to be considered from investing activities. Often students will go through all of the operating activities, fill in their GST in and out, received and paid, then do their investing activities. They won't come back and amend the GST received and paid. It'll cross their mind that it attracts GST. It doesn't attract GST, but they won't necessarily go back and do it. So you have to be having that presence of mind to go back and amend it.
Yeah, so like what I'd like to do when because GST is one of the hardest aspects. It's so easy to get it wrong on the cash flow statement. So I normally have a running total on the side somewhere about when I'm entering all the cash in, or if I go through every single item that they've given me and I add the GST on and keep it running so then you don't mess anything up and then double check it after. So yeah, GST is just little small things that you'll mess up and that's yeah.
Yeah. Cool. And in the VCA FAQ, they did say that it'll apply to the cash disposal of non-current assets, but not trade-in. So trade-in is where you give an older model of a vehicle or something, and you get a newer one, and the credit goes towards. So VCA doesn't apply GST to that, but for cash disposals, they do. It's a unit 4 concept, but something to keep in mind for the preparation of a cash flow statement. And yeah, if you want to figure out if your overall increase or decrease is correct, you might have an opening and closing bank balance given in the question. So you can sometimes have a way of checking if that equals what you have prepared in the cash flow statement. So you can sometimes figure out if your overall, although the classifications you can't figure out if you've classified in the correct place or not. But the overall, you can sometimes figure it out. And yeah, highlight the question in 3 different colors. Do you have any other tips for the cash flow?
No, not really.
Okay, cool. So we did 2 indicators for profitability. So one indicator for liquidity in unit 3, on top of inventory turnover, accounts receivable turnover, and accounts payable turnover, this is cash flow cover, which is introduced in our chapter 11 of Cambridge. So CFC, cash flow cover, is a liquidity indicator that measures the number of times net cash flows from operations is able to cover average current liabilities. So the formula is net cash flows from operations over average current liabilities. So we have got in this template the figure 17,100 for net cash flows from operations. So if we, let's say current liabilities at the start was 10,000 and current liabilities at the end was 20,000, the average would be 15,000. So 17,100 over 15,000 is 1.14 times, round to 1.1. Again, expressed as times per period, and the change is either faster or slower. Download your page 10 of the VCA study design. You will not regret it.
And just one thing I wanted to add, Aravind was saying before that they'll never ask you to calculate these, but you would have to memorize how it's calculated because then you can understand, like it's really about understanding these concepts. Because as you said, when the change, so if there's an increase in cash flow cover, that can only happen from an increase in the numerator or a decrease in the denominator. So when you're answering questions relating to these indicators, it's really helpful to have that formula because then you can be like, oh, this is why it's happened. It's because it's either an increase in the average current liabilities or a decrease in the average current liabilities or an increase in the net cash flow from operations. So with these, you just really have to, like he always tells us to print out that sheet in your VCA thing and put it in like on your toilet door or something. Somewhere you always see it because you've got to memorize these. And the definition is really important. It's just about understanding. So you'll never have to calculate them, but you'll need to know the formulas.
Yeah, and one of the guys a few years ago, I think he's a Melbourne High guy, he put it as his iPad screensaver. So yeah, it's an idea as well. I don't know if anyone would be keen to do that, but yeah. Okay. If you guys had known the formula and understood changes in numerator and denominator for cash flow cover, you'd be able to make a lot of inroads. I did give this test to some of my students over the weekend, and there was a 3-mark question about cash flow cover, and no one got it really fully. So if they had seen this slide, then maybe they would have. Okay, cash versus profit. This question was assessed by VCA very often. It was even assessed in my exam in 2015. They always ask, how is profit higher than cash? How is profit less than cash? How is net cash flows from operations more than net profit? Whatever small variation. So VCA 2023, question 5C, 2022, they skipped it for some reason. 2021, 2020, 2019, it's all the same thing, just slight variations. So you should try and get comfortable with doing these types of questions. And spoiler alert, it is going to be there in the SAC in the back of this booklet. So I would study this whole booklet and then complete the SAC. I'll send the solutions in a couple of days, but like you don't have to open the solution until you complete it. So the way to start a question about cash and profit is that cash and profit are two different concepts. Cash inflows less cash outflows are the cash movement for the period. Revenues earned less expenses incurred is net profit in the period per the accrual basis assumption. Not all revenues earned are cash inflows, and not all expenses incurred are cash outflows. Okay, so there's 4 types of subcategories here that I'll go through. There are some revenues earned that are not cash inflows. For example, credit sales is a revenue, but it's not a cash inflow. If you're thinking about a cash inflow that relates to this revenue, you have to consider receipts from accounts receivable. Silence, guys. 15 minutes, hang in there, and then you can go home. All right. So if you're talking about how profit is increasing by more than cash, it could be due to credit sales being higher than receipts from accounts receivable. It could also be due to having an inventory gain, because inventory is a non-cash inflow. It's just inventory magically appeared, or discount revenue, or profit on disposal of a non-current asset, which you'll see in Unit 4. There are also some cash inflows that are not revenues earned. So for example, proceeds from disposal of non-current asset, loan received, capital contribution, GST refund, GST received. The difference between GST refund and GST received is GST refund is from the ATO, GST received is from everyone else. The same with the cash outflows there. GST settlement is to the ATO and GST paid is to everyone else. Expenses incurred that are not cash outflows. Cost of sales would be an expense incurred, but it's not a cash outflow. It's essentially the expense for inventory leaving the business. So the corresponding cash outflows for that are payments to accounts payable when you're paying the supplier for credit purchases of inventory and also cash purchases of inventory. So these two cash outflows need to be compared with cost of sales. Some other things are inventory write-down, inventory loss, depreciation of non-current assets, discount expense, and loss on disposal of non-current assets. The final thing in this section of cash versus profit is cash outflows that are not expenses incurred. So for example, purchase of non-current assets, loan repaid, cash drawings, GST paid, and GST settlement. And relate to the case study. Wherever you can find examples in the case study, use those. It's always preferred to hypotheticals. Do you have any tips, Vimani, about how you approach these types of questions?
Well, because the questions that surround these they are just asking about, like, they give you two different profit and cash balances, and they're like, why is it different? That's basically what all these questions are going to be like. And so as long as you understand what items can influence either cash or profit, then you'll be pretty good when answering these questions. So yeah, like just all of these dot points is basically what you've got to know. I don't think there's many tips and like shortcuts to do this. Just understanding these concepts about the fact that cash and profit are different things. So yeah, that's all.
Yeah, cool. Maybe make a template answer for 4 marks. Take these 2 slides and add to them. I put a few examples in, but I'm sure there are more. So as you come across them throughout the rest of the year, just keep adding to them. Okay, cool. Our final topic for today will be account reconstruction. So this is a very common thing that's assessed by VCA. The purpose of this is to determine what the cash inflows and outflows are from the information provided in the question to disclose in accounting reports. So the most common accounts are accounts receivable to find cash receipts from accounts receivable, inventory to find credit purchases of inventory, and accounts payable to find cash payments to accounts payable. With accounts receivable and accounts payable, you will often need to determine what the discount is as well, because you have discount revenue and discount expense to consider. And as I said, it's assessed by VCA very often, every single year of this study design so far. So 2019, question 2 was 7 marks, 2023, 2022, 2021, 2020. If I remember correct, 2021 was accounts receivable, accounts payable, inventory, and capital. That was a 12-mark question, followed by an 8-mark cash flow statement. That was a 20-mark practical question. So, you won't always get 4 ledgers, you probably get 2. Sometimes you might only get 1. But yeah, the max was 4. If it's been on only 5 years of this study design, it's more than likely to come again in the 6th. Okay. An example question. Virus's vacuums. So I'll show you one ledger, the accounts receivable one, and then I'll get you guys to do inventory and accounts payable. There will be another question after that, as well as the entirety of the SAC, which is 40 marks. So there'll be a good 50, 60 marks of content for you guys to do after the session in your own time. I will send out the solutions and the slides and a digital copy of the booklet to everyone who has registered on Eventbrite and also who completes the survey, so that, because otherwise I won't have your email addresses. So we will go through this and then I'll give you a chance to do the survey as well. Okay, so to find receipts from accounts receivable, the way you would do it is you'd put the opening balance in of 25,000, closing balance of 22,000, and the sales / GST, sales returns / GST, discount, and bank. So it's essentially like preparing a normal general ledger account, but in this case, you have the closing balance and you're trying to find a missing figure, which is the bank. You're not trying to find the closing balance. So to show you the accounts receivable, The opening balance is 25,000. The closing balance is 22,000. The sales are 100,000, excluding GST. The sales returns are 10,000, excluding GST. So you have to add 10,000 and add 1,000 respectively. Since you have the debits as 135,000, you put 135,000 on both sides, subtract the closing balance, subtract sales return slash GST, and then you get bank slash discount. So then out of that, 5% of the 102,000 is your discount of 5,100, and the remaining 96,900 is your bank, which is your receipts from accounts receivable. That would be the figure that you disclose in the cash flow statement. The whole purpose of doing this is to find out the missing figure that you're receiving or paying so that you can put that in the cash flow statement. So now I'm going to get you guys to do inventory and accounts payable. There is the templates available to you. So I would do the inventory ledger first, find out what credit purchases of inventory are, and then use that to put into the accounts payable, and then find payments to accounts payable. So this will probably be our last question for the day. So let's have a go at it, and then we'll go through it all together. Vimani and I will come around and help you guys. All right, guys, we will go through the solution to these two ledgers now. We have a very friendly volunteer, Smart. He will explain this to us. Come on now. Round of applause.
Alright, so from sales you can find the cost of sales and inventory. So sales is 100K, markup is 100%. So cost of sales is 50,000, and as a cross reference on the credit side of inventory. And then for the sales returns, it's 10% of sales, which is 10,000. And then therefore the inventory that went out would have been worth 5,000. So inventory was debited 5,000, and the cross reference is cost of sales again. You can add in the balances for the start and end, 20,000 and 30,000 respectively. And then since the inventory is returned to the supplier on the same day, you get accounts payable as the cross reference, and inventory is credited 5,000, which is the sales return. So the purchase return. And then from that, the balances and everything, you can calculate the payments to accounts payable, which is 60,000. No, sorry, not 60,000. Is it 60,000?
No, not in the inventory. 60,000 is great.
Oh yeah, and then so account inventory was accounts payable cross reference on the debit side, and the amount is 60,000. You can input all the values plus GST into the accounts payable ledger, which for the transactions that use accounts payable, you get the balances for accounts payable, 30,000 and 28,000. And then you have the total amount of accounts payable that the business paid. But you also have discount revenue, so you calculate the discount and you split bank and discount revenue, and you get 59,375.
All right, thank you, Smart. Yeah. So there is another question which you can do in your own time, as well as the outcome to practice SAC, which I have just released today. The solutions will be sent out, and that's all from me. I'll hand it over to Amrish, who will close off the event for tonight. Thank you all for coming.
I'll just it's like the guy Aravind the comment and providing a vision for that I'm sure it was super helpful. And if you could take some time, please do the survey, because next time we do the lecture, we want to use your feedback to make it better and improve. And feel free to take any food out on the way as well. Yeah, if you want. But yeah, that's it. Next comment.